Hey everyone, and welcome back to the channel. Today, we're diving into the world of regional banks and a specific ETF that's been making some serious waves lately. That's right, the KRE ETF, which tracks regional banks in the US, has seen a whopping 9.39% increase in just the past month. But before you jump in headfirst, there's more to the story. We'll be dissecting what the KRE ETF is, how it compares to other financial sector options, and the potential reasons behind this recent surge. Is this a one-time blip or a sign of things to come? We'll explore the growth opportunities for regional banks and the factors that might impact their performance, like interest rates. So, buckle up and get ready to learn whether this regional bank ETF is a hidden gem or a risky bet. Let's get started. What is KRE ETF? The KRE ETF, which stands for SPDR-SP Regional Banking ETF, offers investors a way to gain exposure to a basket of stocks in the regional banking sector of the United States. Here's a deeper dive into what KRE is and how it works. Investment objective. The primary objective of KRE is to track the performance of the SP Regional Banking Select Industry Index. This index includes stocks of publicly traded companies that are classified as regional banks by SP Dow Jones Indices. These banks typically operate within a specific geographic area and focus on providing financial services to local communities and businesses. Underlying holdings and selection. KRE employs an equal-weighted methodology for its holdings. This means that each stock in the underlying index has roughly the same weight within the ETF, unlike market cap-weighted ETFs, where larger companies hold a bigger sway. This approach aims to provide more balanced exposure across the regional banking sector and potentially reduce the impact of any single stock's performance on the overall ETF. Here's a breakdown of the selection process. 1. Industry classification. SP Dow Jones Indices classifies companies based on their primary business activities. Companies identified as regional banks become eligible for inclusion in the index. 2. Financial viability. The index considers factors like market capitalization, liquidity, and financial health to ensure the companies are established players. 3. Domicile. The companies must be incorporated and have their primary operations in the United States. 4. Stock exchange listing. The stocks must be listed and traded on a major U.S. stock exchange like the NYSE or NASDAQ. Benefits and considerations. Diversification. KRE offers investors a convenient way to diversify their portfolio by gaining exposure to a variety of regional banks. This can help mitigate risk compared to investing in individual bank stocks. Equal weighting. The equal weighting approach can potentially provide exposure to smaller regional banks that might outperform larger ones in certain market conditions. Cost-effective. ETFs generally come with lower fees compared to actively managed mutual funds. KRE's expense ratio, which covers the costs of managing the ETF, is typically lower than actively managed regional bank funds. However, some key considerations are essential. Sector concentration. KRE concentrates your investment in the regional banking sector. This sector can be more volatile than the broader market, so your returns could be amplified in both directions, up and down. Economic sensitivity. Regional banks are typically more sensitive to economic conditions, particularly interest rates, compared to larger, diversified financial institutions. Limited control. As a passive ETF, KRE tracks the underlying index and doesn't involve active management decisions. What were the primary factors driving the strong performance of KRE in the past month with 9.39% return? Attributing the exact reasons behind KRE's 9.39% return in the past month can be complex, as multiple factors often converge to influence market movements. However, here's a breakdown of some potential key drivers. Favorable interest rate environment. Recent Federal Reserve pronouncements or economic data releases suggesting a slower pace of interest rate hikes could benefit regional banks. Rising interest rates can translate into higher net interest margins for banks, which is the difference between what they pay on deposits and what they earn on loans. So, a pause or slowdown in rate hikes could improve regional banks' profitability. Stronger loan demand. An uptick in loan demand from businesses and consumers could boost regional banks' earnings. This could be due to increased economic activity or businesses seeking loans for expansion. Positive earnings reports. If regional banks within the KRE ETF recently released positive earnings reports exceeding analyst expectations, it could have fueled investor confidence and driven up the share prices of those banks, impacting the overall KRE performance. Market rotation. Sometimes, investor sentiment can shift, leading to a rotation of funds from one sector to another. If investors are currently favoring value stocks or cyclical sectors that tend to outperform during economic expansions, regional banks could benefit from this rotation. Mergers and acquisitions. Consolidation within the regional banking sector through mergers and acquisitions can positively impact the share prices of the involved banks. If such activity was prevalent in the past month, it could have contributed to KRE's rise. How did KRE's performance compare to other financial sector ETFs and the broader market? To understand how KRE performed compared to other financial sector ETFs and the broader market in the past month, as of May 17, 2024, we can delve into a few key benchmarks. Financial sector ETFs. XLF SPDR-SP Financial Select Sector Fund. This ETF tracks the performance of a broad basket of companies in the financial sector, including banks, insurance companies, and investment firms. By comparing KRE's 9.39% return to XLF's performance, you can see if regional banks outperformed the broader financial sector. Other financial sector ETFs. Depending on your investment interests, you might want to compare KRE with ETFs focused on specific subsectors within financials, such as insurance, KIE, or asset management, IYW. This comparison can highlight if the strong performance was unique to regional banks or a broader trend within financials. Broader market. Market indexes. Major stock market indexes like the SP 500, SPY, or the Dow Jones Industrial Average, DIA, represent the overall market performance. Comparing KRE's return to these indexes can reveal if regional banks outperformed, underperformed, or moved in line with the broader market. What is the investment objective of the KRE ETF? The investment objective of the KRE ETF, or the SPDR-SP Regional Banking ETF, is to track the total return performance of the SP Regional Bank Select Industry Index, the index. Here's a breakdown of what this means. Total return. KRE seeks to replicate the total return of the underlying index. This includes not just the price appreciation of the stocks within the index, but also any reinvested dividends they distribute. SP Regional Banks Select Industry Index. This index is designed to capture the performance of a specific segment of the U.S. financial sector, regional banks. SP Dow Jones Indices, the creator of the index, uses specific criteria to select companies classified as regional banks. These criteria might include factors like geographic focus, operating primarily within a specific region of the U.S. Business activities, primarily focused on providing financial services to local communities and businesses. Market capitalization. Typically, regional banks are smaller than national money center banks. Tracking the index. KRE employs a sampling strategy to track the index. This means it invests in a substantial portion, but not necessarily all, of the securities within the index. The goal is to achieve a return that closely resembles the index's performance, while potentially reducing some tracking error, the difference between KRE's return and the index's return. In simpler terms, by investing in KRE, you aim to gain exposure to the performance of a basket of regional banks in the U.S., essentially mirroring the returns of the SP Regional Banks Select Industry Index. Additional considerations. It's important to understand that KRE is a passive ETF. This means it passively tracks the underlying index and doesn't involve active management decisions to outperform the market. While KRE provides exposure to regional banks, it doesn't guarantee that all regional banks will perform well. The performance of individual companies within the ETF can vary. What is the underlying index KRE tracks, and how are the holdings selected? The KRE ETF tracks the performance of the SP Regional Banks Select Industry Index, but the selection process for the holdings within this index goes a bit deeper. Here's a detailed explanation. The underlying index, SP Regional Banks Select Industry Index. This index, created by SP Dow Jones Indices, focuses on capturing the performance of companies classified as regional banks in the United States. These banks typically operate within a specific geographic area and cater primarily to local communities and businesses. Selection criteria. SP Dow Jones Indices employs a multi-step process to choose the companies that make up the SP Regional Banks Select Industry Index. Here's a breakdown of the key factors. 1. Industry classification. The first step involves identifying companies within the GICS, Global Industry Classification Standard, designated as regional banks. GICS is a globally recognized industry classification system that categorizes companies based on their business activities. 2. Financial viability. Once classified as regional banks, companies undergo further scrutiny to ensure their financial health. Factors like market capitalization, liquidity, and profitability are considered. Only financially sound regional banks are likely to be included in the index. 3. Domicile and listing. The companies must be incorporated and have their primary operations within the United States. Additionally, their stocks must be listed and actively traded on a major U.S. stock exchange like the NYSE or NASDAQ. Selection nuances. Market capitalization. Unlike some ETFs that weight holdings based on market size, larger companies have a bigger influence. The SP Regional Banks Select Industry Index utilizes an equal weighting methodology. This means each eligible regional bank within the index has roughly the same weight in the overall index composition. This approach aims to provide more balanced exposure across the regional banking sector and potentially reduce the impact of any single bank's performance on the entire index. Periodic reviews. The SP Dow Jones Indices team periodically reviews the composition of the index. Companies that no longer meet the eligibility criteria, e.g., due to mergers, acquisitions, or changes in business focus, might be removed, and new qualifying regional banks might be added to maintain a representative sample of the sector. Understanding KRE's holdings. By tracking the SP Regional Banks Select Industry Index, KRE indirectly inherits the same selection process. You won't necessarily find a list of the exact holdings within KRE due to the equal weighting methodology, but you can be confident that the ETF provides exposure to a basket of financially sound, U.S.-listed regional banks. Benefits of the selection process. Diversification. The selection process helps ensure KRE offers exposure to a variety of regional banks, mitigating risk compared to focusing on individual bank stocks. Focus on financials. The GICS classification ensures the holdings are truly regional banks, not companies from other financial sectors. Equal weighting. This approach can potentially provide exposure to smaller regional banks that might outperform larger ones in certain market conditions. How does KRE's expense ratio compare to other financial sector ETFs? KRE's expense ratio is generally considered competitive compared to other financial sector ETFs. Here's a breakdown to help you understand. Expense ratio explained. The expense ratio is an annual fee expressed as a percentage of assets under management, AUM, that covers the costs of operating the ETF. These costs can include management fees, administrative expenses, and other operational costs. KRE's expense ratio. As of May 17, 2024, KRE typically has an expense ratio around 0.35%. This means for every $10,000 invested in KRE, you would pay roughly $35 annually in fees. Comparison with other financial sector ETFs. Generally, expense ratios for financial sector ETFs can range from 0.10% to 1% or even higher depending on the specific ETF and its underlying strategy. Here's a comparison of expense ratios for some popular financial sector ETFs. Figures are approximate and may vary slightly. XLF, SPDR-SP Financial Select Sector Fund around 0.1%, lower expense ratio. IYF, iShares US Financials ETF around 0.4%, similar to KRE. KBE, SPDR-SP Bank ETF around 0.35%, similar to KRE. Actively managed financial sector ETFs, expense ratios can be significantly higher, often exceeding 1%. Understanding the comparison. KRE's expense ratio falls within the mid-range for financial sector ETFs. It's lower than some actively managed options, but higher than some broad-based financial sector ETFs like XLF. What is the expected volatility of KRE compared to other asset classes? Here's a breakdown of the expected volatility of KRE compared to other asset classes. KRE Regional Banks ETF. Generally, KRE is expected to be more volatile than the overall stock market. Here's why. Sector concentration. KRE focuses on the regional banking sector, which can be more cyclical and sensitive to economic conditions compared to the broader market. Equal weighting. The equal weighting methodology in KRE means even smaller regional banks can have a significant impact on the overall ETF's performance, potentially amplifying volatility. Comparison with other asset classes. Stocks. Individual stocks can be even more volatile than KRE, but the overall stock market, represented by indexes like SP 500, tends to be less volatile due to diversification across various sectors. Bonds. Generally, bonds are considered less volatile than stocks, especially government bonds. This is because they offer a fixed income stream and are backed by the issuing government. Cash and cash equivalents. These are the least volatile investments as they offer a guaranteed return, though interest rates might be low. Real estate. Real estate investment trusts, REITs, can be more volatile than bonds, but less volatile than stocks. Their volatility can depend on the specific property types they invest in. Commodities. Commodities like oil or gold can experience significant price swings, making them more volatile than stocks in some cases. Factors affecting volatility. Interest rates. Changes in interest rates can significantly impact the profitability of regional banks, thus influencing KRE's volatility. Economic conditions. Economic recessions can disproportionately affect regional banks compared to the broader market, leading to higher volatility for KRE. Investor sentiment. Market sentiment towards the financial sector or regional banks specifically can also contribute to KRE's volatility. Understanding volatility. Volatility is a measure of the price fluctuations of an investment over time. Higher volatility indicates larger price swings, both up and down. Investors with a lower risk tolerance might prefer less volatile asset classes like bonds or cash equivalents. Investors seeking higher potential returns might be comfortable with the increased volatility of KRE if it aligns with their investment goals and time horizon. Are there other ETFs offering exposure to the regional banking sector? While KRE, SPDR-SP Regional Banking ETF, is a popular choice for exposure to the regional banking sector, there are indeed other ETFs offering similar investment opportunities. Here's a breakdown of some alternatives. Direct competitors. 1. RWK, iShares Regional Bank ETF. This ETF tracks the Dow Jones U.S. Regional Banks Index, offering exposure to a basket of regional banks similar to KRE. However, RWK might have slight differences in holdings and weighting methodologies compared to KRE. 2. KABA, First Trust Nasdaq ABA Community Bank Index Fund. This ETF focuses specifically on smaller regional banks and community banks within the U.S. It tracks the Nasdaq ABA Community Bank Index, which might be suitable if you're interested in a more niche segment of the regional banking sector. Broader financial sector ETFs. While not solely focused on regional banks, some broader financial sector ETFs offer significant exposure to this sector. 1. XLF, SPDR-SP Financial Select Sector Fund. This ETF tracks the SP Financial Select Sector Index, which includes a mix of companies across the financial services industry, with a sizable allocation to regional banks alongside other financial institutions like investment banks and insurance companies. 2. IYF, iShares US. Financials ETF. Similar to XLF, IYF offers exposure to a broad basket of U.S. financial companies, with a portion allocated to regional banks. How sensitive is KRE's performance to interest rate changes? KRE's performance is generally considered sensitive to interest rate changes, particularly compared to the broader market. Here's a breakdown of why. Impact on profitability. Regional banks rely heavily on the spread between the interest they pay on deposits and the interest they earn on loans, net interest margin. When interest rates rise, banks can potentially charge higher interest rates on loans, which could boost their profitability. However, the impact might be delayed as existing loans with fixed rates mature and are replaced with new loans at higher rates. When interest rates fall, banks might struggle to maintain their net interest margin as they have to compete for deposits by offering higher rates, while loan rates might not decrease as quickly. Investor sentiment. Rising interest rates can signal a stronger economy, potentially leading to increased loan demand and benefiting regional banks. This can attract investors and drive up KRE's price. Conversely, falling interest rates might indicate a weakening economy, leading to concerns about loan defaults and impacting investor confidence in regional banks, potentially causing KRE's price to decline. Sensitivity compared to other sectors. Regional banks are generally more sensitive to interest rates compared to other sectors like technology or consumer staples. These sectors might be less reliant on traditional lending and borrowing activities. Factors influencing sensitivity. Loan portfolio composition. The types of loans a regional bank issues can influence its sensitivity to interest rates. For example, banks with a higher concentration of adjustable-rate mortgages, ARMs, might see a quicker impact from rate changes compared to banks with mostly fixed-rate loans. Deposit base. Banks with a stable deposit base, loyal customers who don't move their money frequently, might have more flexibility in adjusting their interest rates on deposits when market rates change. Challenges in predicting impact. The exact impact of interest rate changes on KRE's performance can be difficult to predict. It depends on the magnitude and speed of the rate changes, the overall economic conditions, and the specific strategies of the banks within the KRE ETF. What are the potential growth opportunities for regional banks? Regional banks face competition from national financial institutions and fintech startups, but they also possess unique strengths that can fuel growth. Here's a breakdown of some potential growth opportunities for regional banks. Focus on local communities. Deep customer relationships. Regional banks often have strong relationships with local businesses and residents. They can leverage this to offer personalized financial services and solutions tailored to the specific needs of their communities. Small business banking. Small businesses are the backbone of many local economies. Regional banks can cater to their specific needs by offering loan products, cash management services, and financial advice. Community development. By supporting local businesses and initiatives, regional banks can position themselves as trusted partners within their communities, fostering long-term loyalty. Technological innovation. Digital banking services. While some may perceive regional banks as lagging behind in technology, many are adopting digital tools to improve customer experience. Offering mobile banking, online account opening, and digital lending platforms can enhance convenience and attract new customers. Fintech partnerships. Regional banks can collaborate with fintech startups to leverage their innovative technologies in areas like payments, data analytics, and cybersecurity. This allows them to compete more effectively with larger institutions while offering cutting-edge solutions to their customers. Expanding service offerings. Wealth management. Regional banks can cater to the growing demand for wealth management services by offering investment products and financial planning advice to their existing customer base. Specialized banking. Some regional banks are focusing on niche markets like healthcare or agriculture, developing expertise and building a competitive edge in these specific sectors. Regulatory environment. Changes in banking regulations. Regulatory changes favoring regional banks over larger institutions could create growth opportunities. This could involve easing restrictions on the types of financial products regional banks can offer or reducing compliance burdens. Challenges to consider. Competition. Regional banks face stiff competition from national banks and fintech companies. Maintaining a competitive edge requires continuous innovation and customer focus. Economic downturns. Regional economies can be more susceptible to economic downturns compared to the national economy. This can lead to higher loan defaults and impact profitability. What are the expense ratios and fees associated with investing in KRE? Here's a breakdown of the expense ratios and fees associated with investing in KRE, SPDR-SP Regional Banking ETF. Expense ratio. KRE typically has an expense ratio around 0.35% as of May 17, 2024. This represents the annual fee charged as a percentage of the ETF's assets under management, AUM. It covers the costs of operating the ETF, including management fees, paid to the ETF provider for managing the fund and ensuring it tracks the underlying index, SP Regional Bank Select Industry Index. Administrative expenses, costs associated with fund operations, such as legal fees, accounting fees, and custodial fees for holding the underlying assets. Understanding expense ratios. The expense ratio is an important consideration when choosing an ETF because it directly impacts your returns. A lower expense ratio translates to a higher potential return for you as there are fewer fees eating into the ETF's performance. Compared to other financial sector ETFs, KRE's expense ratio falls within the mid-range. Some actively managed financial sector ETFs can have significantly higher expense ratios exceeding 1%. Additional fees. While the expense ratio is the primary cost associated with owning KRE, there might be some additional fees to consider depending on your investment platform. Commission fees. Some brokers charge commission fees for each ETF trade you place. This fee can vary depending on the broker and the type of account you have. Bid-ask spread: when you buy or sell shares of an ETF, you'll typically do so at the ask price, slightly higher than the net asset value or NAV, or the bid price, slightly lower than the NAV. This difference is known as the bid-ask spread and represents the market maker's fee for facilitating the trade. Alright, so we've unpacked a lot about the KRE ETF and the recent surge in regional bank performance. Here are the key takeaways. KRE tracks a basket of U.S. regional banks, offering exposure to this specific sector. Compared to the broader market, KRE can be more volatile due to its focus and sensitivity to interest rates. Several factors can influence regional bank growth, like strong local relationships, technological innovation, and economic conditions. While the 9.39% return is exciting, past performance doesn't guarantee future results. Ultimately, the decision to invest in KRE depends on your risk tolerance and investment goals. If you're looking for pure regional bank exposure and are comfortable with some volatility, KRE could be a good option. However, remember to diversify your portfolio across various asset classes to manage risk. For more info on ETFs, regional banks, and how to build a balanced portfolio, check out the resources in the video description below. And don't forget to like and subscribe for more investment insights.